Welcome back, everyone. Ready for another deep dive?
Always.
Awesome. Today, we're going back in time a bit.
Oh, sounds intriguing.
Yeah. We've got these excerpts from a David Stendhal workshop from, get this, 1999.
Wow, back when we had dial-up internet.
I know, right? But what's fascinating is that he's talking about money management, and these principles, well, they're kind of timeless.
Absolutely. The markets change, but the psychology of trading and how we manage risk and reward, those core concepts are always relevant.
Exactly. So Stendhal, he's diving into two trading systems, one for yen, one for corn. He looks at them individually first, then as a combined portfolio.
Classic approach really helps to highlight the impact of diversification.
Right. But before he even gets into the systems, he spends a good chunk of time just hammering home like the absolute importance of money management.
Which, some people might find boring, but he really drives home the point that even with a winning system, if you don't manage your money right, you're toast.
Yeah, it's like you can have the best recipe for, I don't know, chocolate cake. But if you just, eyeball the ingredients, disaster.
Exactly. Precise measurements, understanding the ratios, that's what makes a cake, or a trading account, successful.
Okay, so Stendhal lays out all these metrics for evaluating a trading system. Net profit, percent profitable, profit factor, the whole 9 yards.
Stuff that most traders are probably familiar with. But then he throws in some less common ones, like the RNA index, which really digs into the consistency of those profits.
Yeah, I found that one really interesting. So when you're looking at a new system, do you dive into those more nuanced metrics right away, or do you start with the basics like net profit and kind of work your way up?
Honestly, it depends. Sometimes the basics are enough to tell you, nope, not for me. But other times, those less common metrics, they can reveal hidden gems or, red flags you might have missed otherwise.
Okay, that makes sense. So one thing Stendhal keeps coming back to is the idea of stability. He's not just looking for a system that makes money. He wants to see consistent profits over time.
Right. It's not about hitting home runs every time. It's about those singles and doubles that add up over the long haul.
Makes sense. And he shows this total trade stability exhibit, which is basically a graph showing how tightly all the trades cluster around the average.
A great way to visualize consistency, If the trades are all over the place, that's a roller coaster you might not want to ride.
Right. Give me a nice, smooth, upward trending line. So in the yen system he analyzes, most of the trades are pretty tight, except for this one crazy outlier, trade number 90. But overall, pretty stable. I'm curious, for you, what would it feel like to trade a system that predictable, knowing you can kind of, anticipate how things will play out?
Honestly, it'd be a dream. Of course, no system is perfect, but having that level of stability, it'd give you so much confidence to stick to your plan, even when the market's throwing curveballs.
Totally. Okay, now things get really interesting when Stendhal dives into drawdown and run up. So he's talking about the maximum potential loss and profit a trade might hit. And he brings up this thing called the underwater equity curve. Sounds a bit ominous.
Yeah, it's basically a way to visualize the system's history of drawdowns, those periods where you're, underwater. Not exactly a feel-good chart, but it forces you to confront those potential downsides, which is essential.
Right. So it's not just about, ooh, look how high this system could go. It's also, okay, how low could it dip? And am I comfortable with that?
Exactly. And that ties into risk tolerance, which is so personal, right?
Totally.
Yeah.
Speaking of personal, given your experience, how comfortable are you with those big swings? Are you the type who rides it out, or do you prefer to cut losses quickly?
It's evolved over time, to be honest. I used to be much more cut and run, but as I've gained more experience, I've become more comfortable with letting trades play out, as long as they're within my risk parameters, of course.
Okay, yeah, that makes sense. And that's a good thing to keep in mind as we dig into these specific money management strategies Stendhal lays out, because some of them are designed for folks who thrive on volatility, while others are more for, those of us who prefer a smoother ride.
Absolutely. There's no one-size-fits-all in money management. It's all about finding what aligns with your personality and your trading goals.
Okay, so let's jump into those strategies. He kicks things off with maximum adverse excursion, or MAE, basically using historical data to figure out where to set your stop-loss orders.
Right, pre-committing to an exit point, which can be really helpful psychologically, especially when things get heated.
Yeah, it takes some of the emotion out of it.
Yeah.
But I'm thinking if you're too tight with your stops, you might miss out on trades that would eventually become profitable, right?
Definitely something to consider. It's about finding that balance, you know?
Hmm.
Limiting losses, but also giving your trades enough room to breathe.
That makes sense. Okay, and then on the flip side, he's got maximum favorable excursion, or MFE, which is all about adding to a winning position, like riding that wave.
Ah, yes, the classic let your winners run strategy. It can be very powerful for accelerating profits, but it also requires a certain level of, I don't know, maybe a bit of daring.
I was going to say risk tolerance, but
Yeah.
daring works too. It's like you're essentially doubling down on a trade that's already going in your favor.
Right, and that can be exhilarating, but also potentially dangerous if you're not careful. You have to know when to let go, too.
Right, ride the wave, but don't get swept away. Okay, so we've got MAE for damage control, MFE for maximizing those wins, and then he throws in fixed fractional trading.
Which, if I had to guess, is probably the most popular approach among, well, at least more disciplined traders.
Yeah. Why do you think that is?
It's all about risk management. With fixed fractional, you're always risking a fixed percentage of your total capital, no matter how big or small your account is.
So like if you have a $100,000 account and risk 2%, you're risking $2,000 per trade. If your account grows to $200,000, you're now risking $4,000.
Exactly. So your risk scales with your account size, which helps you avoid, over leveraging yourself as you grow.
Makes sense. It's like a built-in safety mechanism. Okay, but then he drops this bomb, drawdown support, adding to a losing position.
Yeah, that one usually gets some raised eyebrows.
Kind of counterintuitive, right? Like most people are taught to cut their losses, not add to them.
Right, but Stendhal emphasizes that this isn't about blindly averaging down. It's about using historical data to identify those specific points where a system tends to reverse.
So it's like a calculated gamble based on patterns and probabilities.
That's a good way to put it. And to be clear, it's a high-risk, high-reward strategy, not for the faint of heart.
Definitely not. Wow. So we've got a whole toolbox of money management strategies here. MAE for damage control, MFE for maximizing those winning streaks, fixed fractional for scaling your risk, and drawdown support for, well, supporting those drawdowns in a calculated way. It's almost overwhelming, but kind of exciting too.
It is. It shows you just how much depth there is to this whole money management thing. It's not just about picking a random percentage and hoping for the best.
Right. There's a real art to it. Finding the right strategies that work for you, your system, your risk tolerance.
Absolutely. And I think what's key is to not just get caught up in the mechanics of the strategies themselves. You have to consider the psychological side of it, too.
Oh, yeah, for sure. Like some of these strategies, they take real mental fortitude to execute.
Imagine using drawdown support, adding to a losing position. That takes nerves of steel.
I know. Even something like MFE, as appealing as it might sound, can be emotionally taxing. You're constantly fighting that urge to lock in profits.
Exactly. So how do we bridge that gap between like the theory of these strategies and the actual gut-wrenching experience of trading?
That's the million-dollar question, isn't it? Maybe that's what we should explore next time, how to like develop that mental game to actually implement these strategies effectively.
I'm in. Let's dive into the psychology of money management.
So we're back, and we're diving headfirst into the psychological side of money management. Because as we were saying, you can have the best strategy in the world, but if you can't execute it, well, it's not going to do you much good.
Right. I mean, think about it. You're staring at your screen, the market's going crazy, your heart's pounding, and you've got to make a decision fast.
Yeah, and that's when those emotions, fear and greed, they can really take over.
Exactly. So how do we stay cool under pressure? How do we, bridge that gap between the theory and the actual experience of trading? Stendhal talks a lot about the importance of self-awareness, like really understanding your strengths and weaknesses as a trader.
Yeah, like are you someone who tends to second guess yourself? Do you get impatient? Do you jump the gun? Or do you hold on too long, hoping things will turn around?
Exactly. We all have our tendencies, right? So the key is to identify those tendencies and then, choose strategies that complement your natural style, your personality,
I like that. Finding a money management strategy that fits your personality.
It's a great way to think about it.
So let's revisit those strategies we talked about. But this time, let's look at them through that psychological lens. We've got MAE, setting those stop-loss orders based on historical data.
Right. And that can be really helpful for those who tend to, freeze up when things start going against them. It's like having that predetermined exit point takes some of the pressure off.
It's like a safety net.
Exactly. And then there's MFE, adding to those winners. That takes a different kind of mental fortitude, right?
Yeah. because you're constantly fighting that urge to cash out, lock in those profits. You have to trust the system, trust your analysis, and, ride that wave.
And that can be tough, especially when you're watching those unrealized profits just like melt away as the market pulls back. It's like walking a tightrope.
Ooh, that's a good analogy.
Yeah.
So if you're someone who, gets vertigo easily, maybe MFE isn't the best fit.
Probably not. But for those who, enjoy that thrill, who have the discipline to stick to the plan, it can be incredibly rewarding.
Okay, and then there's fixed fractional trading, risking that fixed percentage of your capital. I like that one because it feels like, I don't know, it's kind of grounding.
Yeah, I get that. It helps to keep you from getting carried away by, greed or fear. It's like a built-in governor on your emotions.
Exactly. And then there's, of course, the wild card. Drawdown support, adding to a losing position. That takes serious guts.
Yeah, it's not for everyone. But again, remember, Stendhal emphasizes that this isn't just about throwing good money after bad. It's about using historical data, identifying those points where the system tends to reverse.
It's like you're not just hoping things will turn around. You're basing your decision on evidence.
Right. It's a calculated risk, and like any calculated risk, it can pay off big time, or, well, it can go the other way.
Right. High risk, high reward. So we've got these 4 distinct strategies, each with its own psychological profile. It's like a personality test for money management.
Huh. I like that. So I'm curious, for you, which one of these strategies resonates the most?
Honestly, I think I lean towards fixed fractional trading. I like that idea of scaling my risk as my account grows. It just feels, I don't know, responsible. Like I'm not going to suddenly bet the farm just because I had a couple of good trades.
Yeah, that makes sense. It's a very logical, disciplined approach.
But, part of me also kind of likes the idea of MFE, riding those winning waves. Maybe that's something I can explore more as I gain experience and confidence.
There you go. It's all about finding that balance, right, between playing it safe and pushing the boundaries. But before we get too lost in the strategies themselves, let's remember we've got to tie this back to the actual systems, right?
Right. Stendhal doesn't just leave us hanging with these theoretical concepts. He actually shows us how these strategies play out using those yen and corn systems.
Exactly. So let's start with the yen system. Remember, he highlighted its stability, its overall profitability. It's like the perfect candidate for testing out these different money management approaches.
Okay, so what jumps out at you when you look at how he applies those strategies to this specific system?
Well, one thing that really struck me was how effectively he uses MAE to manage that drawdown. Remember that outlier trade we talked about earlier, number 90?
Yeah, the one that kind of threw off the whole stability chart.
That one. By setting that stop loss based on historical data, he's able to significantly reduce the impact of that trade without sacrificing too much of the potential profit.
So it's like, okay, we know these outlier trades happen, so let's have a plan in place to mitigate the damage.
Exactly. And what's really cool is that even with that stop loss in place, the system still generates some pretty impressive returns.
It's like he's not just protecting capital, he's also preserving the upside potential.
Right. And then he goes on to explore MFE with the yen system. Remember, that's about adding to those winning positions.
Yeah, okay, this trade's going in my favor. Let's pour some more fuel on that fire.
And in this case, the fire really takes off. He shows how adding to that position at specific profit levels can lead to a substantial increase in the overall profitability.
Man, that's got to be exciting to watch. But I bet it takes a lot of discipline to stick with that plan, not get greedy and cash out too early.
Oh, absolutely. It's all about finding that balance between maximizing those profits and, not letting those gains slip away.
Okay, so we've seen how MAE and MFE play out with the yen system. What about fixed fractional trading? Does he explore that one too?
He does. And get this, he actually combines fixed fractional trading with MFE.
Whoa, wait, you can do that? Combine those strategies?
You can. And in this case, it's a really powerful combo.
Like a dynamic duo of money management.
Exactly. It's all about finding those synergies, leveraging the strengths of each approach to create something even stronger.
I love that. Okay, so we've seen how Stendhal tackles the yen system. What about the corn system? Remember, that one's a bit less volatile, but it still offers opportunities for applying those strategies.
Right. And one thing that's interesting is how he adjusts the MAE stop loss level to account for that lower volatility. Yeah. Instead of using a really tight stop loss like he did with the yen system, he opts for a wider stop, recognizing that the corn market might need a little more room to breathe.
So it's not just about blindly applying the same strategy across the board. It's about adapting to the specific characteristics of each market.
Exactly. You got to be flexible, adjust your approach based on the situation.
Okay, that makes sense. So even with the corn system, those money management strategies still come into play. It's just a matter of tweaking them to fit the market.
Right. And he shows how even with that wider stop loss, you can still effectively manage the drawdown and, keep those profits flowing.
All right, so we've seen how he applies these strategies to both the yen and the corn systems individually. But now things get really interesting when he combines those two systems into a portfolio, right?
Right. That's where we start to see the magic of diversification.
Yeah, not just in terms of smoothing out the returns and reducing the drawdown, but also in how he manages the money in that combined portfolio. It's not just about applying the strategies at the individual system level. It's about managing the whole portfolio as one.
Precisely. It's a more holistic approach, taking a step back and looking at the bigger picture.
Okay, so how does that actually work? Does he just apply the same strategies at the portfolio level?
Yep. He takes those same strategies we've been talking about, MAE, MFE, fixed fractional. But now, instead of applying them to each individual system, he's applying them to the portfolio as a whole.
So, instead of setting a stop loss for each trade in each system, he's setting a stop loss for the entire portfolio.
That's the idea. It's about managing the overall risk and reward of the portfolio, rather than just focusing on the individual components.
I see. And this is where things get, really sophisticated, right? Because now you're dealing with multiple markets, multiple systems, all interacting with each other.
Exactly. And that's where Stendhal's expertise really shines. He shows how this approach can lead to even smoother returns, even more reduced drawdowns, compared to, just trading those systems individually.
Wow, that's impressive. But I gotta admit, some of this stuff, it goes over my head a bit. He throws out all these metrics for evaluating portfolio performance, like the RINA index, the return retracement ratio, the Sharpe ratio. Can you break those down for me in a way that, even I can understand?
Sure. I think the key to understanding these metrics is to remember that they're all trying to answer the same fundamental question, which is, how efficient are our returns relative to the risk we're taking?
Okay, yeah, that makes sense.
Yeah.
It's not just about making money. It's about making money in a way that, doesn't expose us to unnecessary risk.
Right. So, for example, the RNA index, think of it like a report card for your portfolio. It's grading the performance based on both, the profitability and the consistency of those profits.
So it's not enough to just have a few big wins. You need to be consistent over time.
Exactly. The RNA index, it's going to penalize those systems that have wild swings, even if they have, high overall returns. It's all about finding that sweet spot between profitability and stability.
Got it. What about the return retracement ratio, or RRR? What's that one all about?
The RRR, it basically measures how much profit you're making for every unit of drawdown you experience. So, are you being adequately compensated for those losses with, substantial gains?
Okay, so it's like a risk-reward ratio for your portfolio.
Exactly. And then there's the Sharpe ratio, which is another popular one.
Yeah, I've heard of that one, but I'm not exactly sure what it means.
The Sharpe ratio, it compares the returns of your trading system or portfolio to a risk-free rate of return.
So what you could get if you just put your money in a savings account.
Right, or a government bond, something like that. So it's basically saying, okay, am I being adequately compensated for the extra risk I'm taking by trading as opposed to just, parking my money in a safe investment?
Okay, that makes sense.
Yeah.
So higher Sharpe ratio, better risk-adjusted returns.
Exactly. And what's cool is that Stendhal shows that the combined portfolio, the one with both the yen and the corn systems, it actually performs better on these metrics than either system by itself.
So diversification really does work. Not only does it smooth out those returns and reduce the drawdown, but it can actually lead to more efficient risk-adjusted performance.
It's a win-win-win situation.
I like it. Okay, so we've talked a lot about these strategies, the metrics, the systems, but I want to circle back to something Stendhal mentions early on, the idea that money management, it's not just about finding the right formula, it's also about the trader's ability to actually execute that strategy.
Absolutely. You can have the perfect plan, but if you don't have the discipline to stick to it, if you let your emotions get in the way, you're going to sabotage yourself.
Yeah, he talks about how some of these strategies, they might require traders to, endure some pretty significant drawdowns, and that could be really tough psychologically.
Oh, for sure. Not everyone has the mental fortitude to ride out those tough times, even if they know, logically, that the system has a good track record.
So what advice does he give for, developing that discipline, that emotional resilience.
Well, he emphasizes the importance of thorough testing, back testing, really
Yeah.
getting to know your system inside and out. So when those drawdowns inevitably happen, you're not caught off guard, you're not panicking. You're like, okay, I've seen this before, I know how the system behaves, I'm going to stick with the plan.
It's about having that confidence, that conviction in your approach.
Exactly. And he also encourages traders to, develop a clear trading plan and stick to it no matter what.
So even when those emotions are screaming at you to do something else.
Even then, it's about taking the emotion out of it, making decisions based on logic, on your predefined rules, not on how you're feeling in the moment.
So it's like discipline over emotion.
You got it. And that's a great place to pause for now, I think.
Yeah, we've covered a lot of ground in this deep dive. We've explored the psychological aspects of trading, those different money management strategies, and how they actually play out in the real world using those yen and corn systems.
We've even deciphered some of those fancy metrics for evaluating portfolio performance.
Right. I feel like my brain is full.
Mine too. But there's still more to come. In the next and final part of this deep dive, we'll wrap things up, talk about some key takeaways, and maybe even leave you with some thought-provoking questions to, ponder on your own trading journey.
Sounds good. Can't wait. Okay, so we're back and ready to wrap up our deep dive into this Stendhal workshop.
It's amazing how much ground he covers, even though it's, over 25 years old now?
Seriously, it's like the core principles of money management, they really do stand the test of time.
Right. Like those markets he's analyzing, yen and corn, those are going to behave differently today, obviously.
Yeah, for sure. But those underlying strategies for managing risk, maximizing gains, that's stuff we can still apply no matter what we're trading.
Absolutely. So want to revisit those systems one last time, see how those strategies play out in practice.
Let's do it. I'm especially curious to see how he fine-tunes those strategies for each system,
Yeah.
Because it's not just a one-size-fits-all kind of thing.
Right, exactly. So the yen system first. Remember, he really liked that one for its stability, its overall profitability.
Yeah, it seemed like a really solid foundation for testing out those different approaches.
And one of the first things he does is apply that maximum adverse excursion, the MAE, to the yen system.
So he's figuring out where to set those stop-loss orders.
Right.
Based on that historical data.
Right, exactly. It's about figuring out that point where historically trades just don't seem to recover.
So it's like preemptively cutting your losses before they get out of control.
Yeah, exactly. But it's not just about randomly picking a number, right? You have to find that balance between protecting your capital and, giving those trades enough room to breathe.
Right, like you don't want to set those stops too tight, or you might miss out on trades that would eventually turn profitable.
Exactly. So with the yen system, he finds that a stop-loss level of around 1.75% of the open trade value, that seems to strike a good balance. It helps to, significantly reduce that maximum drawdown without sacrificing too much of the potential profit.
Okay, so it's like a safety net that's strategically placed to catch you if you fall, but it's not so low that it trips you up along the way.
That's a great analogy. And what's interesting is that even with that stop loss in place, the yen system, it still manages to generate those impressive returns that we talked about earlier.
Yeah, it's a testament to the power of combining a good system with smart money management.
Right. It's not just about finding those winning trades, it's about protecting those wins too.
Okay, so MAE helps to manage the downside. But what about maximizing the upside? That's where that maximum favorable excursion comes in, the MFE, right?
Right, exactly. It's all about, adding to those winning positions, riding that wave of momentum.
Yeah, I love that idea. But I imagine it takes a certain, a certain level of discipline to keep adding to a position as it's moving in your favor. It's got to be tempting to just cash out,
Oh, yeah, absolutely. It's like you're fighting against that natural urge to lock in those profits. You have to trust the system, trust your analysis, and just let it run its course.
Right. Don't get greedy.
Exactly. And in the case of the yen system, Stendhal finds that adding one contract to the position whenever it reaches an unrealized profit of 2.5% or more, that can significantly enhance the overall profitability.
So it's like you're letting those winners run, but you're also strategically adding fuel to the fire as it goes.
Exactly. And that can lead to some pretty amazing results.
Man, I bet it's exciting to watch those gains just multiply as that trade keeps moving in your direction.
It is. It's definitely one of the more, exhilarating aspects of trading.
Okay, so we've seen how MAE and MFE play out with the yen system. What about fixed fractional trading? Does he explore that one too?
He does. And get this, he doesn't just look at fixed fractional trading in isolation. He actually combines it with the MFE strategy.
Wait, you can do that? Like combine those strategies?
You can. It's not just about picking one and sticking with it, It's about finding ways to combine these approaches, leverage the strengths of each one to create something even more powerful.
So it's like a dynamic duo of money management.
Exactly. And in the case of the yen system, that combination, it proves to be really effective. He shows how it can lead to some pretty significant compounding effects, allowing those profits to grow alongside your account size.
It's like, I don't know, like a snowball rolling down a hill, gaining momentum as it goes.
I like that.
Okay, but gotta ask, does he apply that drawdown support strategy to the yen system, the one where you add to a losing position? Because that one still kind of freaks me out.
He doesn't in this case. And I think it's because, the yen system, with its inherent stability and its tendency to generate those consistent profits, it doesn't really lend itself to that kind of approach.
Okay, that makes sense. Like if it ain't broke, don't fix it.
Right. Drawdown support, it tends to be more effective with systems that, have more volatility, those systems that exhibit a clear pattern of reversals.
Got it. It's about choosing the right tool for the job.
Exactly. Okay, so now let's talk about the corn system. Remember, that one's a bit less volatile than the yen, but there are still opportunities to apply those money management strategies.
Yeah, and one thing that really stood out to me was how he adjusts that MAE stop loss level to account for that lower volatility. Like instead of using a really tight stop like he did with the yen, he goes for a wider stop, recognizing that the corn market might need a little more room to move around.
Yeah, it's a great example of how you have to adapt those strategies to the specific characteristics of each market.
Right. It's not just about blindly applying the same formula across the board.
Exactly. And what's interesting is that even with that wider stop loss, he's still able to, effectively manage the drawdown of that corn system without sacrificing too much of the potential profit.
Yeah. It's all about finding that sweet spot, right, between protecting your capital and letting those trades run their course.
Absolutely. And he also applies the MFE strategy to the corn system, finding that, in this case, adding 2 contracts to the position, whenever it hits an unrealized profit of 10% or more, that can really enhance those returns.
Okay, so even though the corn system might not have those big dramatic swings that the yen system has, there are still opportunities to amplify those profits by adding to those winning positions.
Exactly. It's just a matter of, adjusting the parameters to fit the market.
Right, tailoring the approach. Okay, so we've seen how he applies these strategies to both the yen and the corn systems individually. But the real magic, it happens when he combines those two into a portfolio, right?
Right. That's where we really see the power of diversification.
Yeah, and not just in terms of smoothing out those returns and reducing that drawdown, but also in how he manages the money in that combined portfolio. It's not just about managing each system on its own. It's about managing the portfolio as a whole.
Right. It's a much more holistic approach. You're taking a step back, looking at the bigger picture, managing the overall risk and reward of that entire portfolio.
Okay, so how does that actually work in practice? Does he just apply those same strategies, but at the portfolio level?
Yep, that's exactly what he does. He takes those same strategies, MAE, MFE, fixed fractional, but now he's implementing them at the portfolio level rather than the individual system level.
So instead of setting a stop loss for each trade, he's setting a stop loss for the entire portfolio value.
Exactly. It's about, managing that overall risk. And it can get pretty sophisticated, especially when you're dealing with, multiple markets, multiple systems, all interacting with each other.
Right. Now you've got all these moving parts.
Exactly. But Stendhal, he's got it all figured out. And he shows how this approach can lead to even smoother returns, even more reduced drawdowns compared to, just trading those systems individually.
It's like he's conducting an orchestra, all those different instruments, all playing together in harmony.
I love that. It's a great analogy. And he doesn't just tell us about it. He shows us, he's got all those charts and graphs, the portfolio underwater equity curve, the portfolio trade graph, all that stuff to really drive home the point.
Okay, so we've talked a lot about these different strategies, those metrics, the systems. But I want to circle back to something Stendhal mentions early on. The idea that money management, it's not just about finding the right formula. It's also about the trader's ability to actually execute that strategy.
Oh, yeah, absolutely. You can have the perfect plan on paper, but if you don't have the discipline, the emotional resilience to actually stick to it, well, you're going to sabotage yourself.
Yeah, he talks about how some of these strategies might require traders to, like, endure some pretty significant drawdowns. And that can be, like, really tough
Yeah.
psychologically.
For sure. Not everyone has the stomach for that, you know? Even if logically they know the system has a good track record, seeing those big red numbers on your screen, that can be pretty unsettling.
So what advice does he give for, like, developing that discipline, that emotional resilience?
Well, first and foremost, he emphasizes the importance of testing, back testing, really getting to know your system. The more you understand how a system behaves, the more confident you'll be in its ability to, to weather those storms.
So it's about, like, having that conviction in your approach, knowing that you've done your homework.
Exactly. And he also talks about the importance of having a clear trading plan and then sticking to it no matter what.
So even when those emotions are, like, screaming at you to do something else.
Yeah. Even then, you got to take those emotions out of the equation as much as possible, Make those decisions based on your predefined rules, not on how you're feeling in the moment.
Discipline over emotion.
Exactly.
Man, there's so much to unpack here. Like, it's not just about the numbers. It's about the psychology, too.
Right. It's all connected.
Well, I think that's a great place to wrap things up for this deep dive.
Yeah.
We've covered a lot of ground, explored those different money management strategies, and we've even seen how they play out in the real world.
And we've learned that money management, it's not just an optional add-on, it's an essential element of successful trading.
Yeah, it's like the foundation upon which everything else is built.
Exactly. And the cool thing is, no matter what system you're using, what markets you're trading, these principles, they still apply.
So keep learning, keep experimenting, and most importantly, find those money management strategies that work for you.
That's the key.
Thanks for joining me on this deep dive. Until next time.